Let's start off with where we are when it comes to the UK property market. We keep hearing news reports in the media that yes, we've seen a bit of a recovery, but there's still quite a lot of opportunities ahead.
The UK property market has been, well, prime property in the UK has been recovering over the past 15 months. Probably 25 to 30% off its base lows 15 months ago. As a result, if you're looking at getting into prime property, where I would recommend foreign investors, especially South Africans, looked, you will be competing with institutions and other private individuals in the UK. I think last year the CBRE report saw total growth of 16.1%, or total returns of 16.1% in the UK property market, which is a very strong year and stronger than many expected. CBRE are Broll Property Group's partners in the UK. And obviously I'm in contact with them a lot.
Well, I mean, clearly with returns that you're talking about, 16.1%, one would say, well, is it a good time to buy into UK prime property right now?
I think that it is a good time from the point of view of the strength of the rand historically. I know that there's looking into the future is always an inaccurate science, but as a diversification for a South African, it's still very attractive. And I say this because as a property investment, it is very different to South African commercial property. In the UK, you have long, strong leases that are on a triple net basis. You also have non-recourse debt. Effectively, the people investing into the properties do not have to sign personal surety on that kind of debt. Going into the future with regard to growth in UK prime property, I would still recommend that you look at specific areas, probably the southeast, because there's been stronger rental growth forecast in the southeast.
Okay, well, you mentioned the sterling and the rand. We're sitting at an exchange rate that's oscillating around the 11 rand mark. Going forward, we are expecting a little bit of rand weakness. Some say that we could see a big outflow from the bond market going forward, which could mean an even weaker rand going forward. So what you're saying is it's a really good time now that we do have such a strong currency and the incentive is far greater.
Well, obviously there are a couple of variables when entering a foreign market like the UK commercial property market, and one of the major variables is the currency. And with rand strength, that obviously makes it an attractive time, I believe, from a currency standpoint. With regard to obviously other variables, then you have to look at the strength of the UK commercial, the prime market going forward. And that, look, we've seen a lot of stability, and there is also, I mean, as I've spoken about the rental growth.
Yeah. Okay, we're talking about exchange control allowances increasing 4 million rand per year. You know, looking at some of the reports that you've written, you're talking about it even becoming a more viable investment option. So now is the time. How much would a South African need going into the commercial property market in rand terms?
The majority of what I would call attractive investments would start at about £2 million. Now, with debt available in prime property between 60 and 70%, you would need about £600,000 to £700,000 to start looking at these kind of investments. With 4 million rand per person, so that would mean that a couple or two people as a partnership could buy a property like that each year. This is fundamentally different to prior to the new exchange controls, because at that stage it was only a 1 or 4 million rand allowance.
You're talking about the lease structures and that being relatively different from the UK to what we hear in South Africa. Tell us about the fundamental differences.
First is that almost all of the lease structures are completely triple net. A triple net meaning that that all of the expenses are paid by the tenant. This means that you're able to invest from South Africa and effectively get 4 checks a year. The leases are paid quarterly, and you don't have the normal kind of administration issues that you would owning a South African property. Other than that, the leases are also fundamentally longer, or usually longer, with 10 or 15-year triple net leases available. That means, of course, that you can buy a property with the surety that as long as the tenant doesn't go under, you're not going to have to go there and try and re-tenant or find a new tenant for the property. And this is also very, very attractive for passive investors.
And also, you don't have to sign surety.
Yes, and as I said, non-recourse debt, which means that effectively what you're putting at risk is the equity you put into the deal, so between 30 and 40% of the property price. If something were to go wrong with the property deal, that is what's at risk, and your personal surety is not.
Okay, raising the capital, I mean, ultimately you would do that from the UK.
Raising the debt you would do from the equity obviously would come from South Africa. Yes, the debt market in the UK is very advanced, and at Broll Property Group we have been offering a full service, which is also finding the debt or sourcing the debt for the investors if they so wish. It is readily available in the market. There are far more lenders than there are in the South African market, but it does obviously take significant expertise to source the particular lender for each deal.
At the top you mentioned a great way to diversify your portfolio as a South African, and some would argue we're seeing incredible growth rates coming through for commercial property in Nigeria and other African markets. Why do you think the UK is still an attractive investment for South Africa?
Well, it's definitely not competing with Nigeria. The UK I see as a favourable opportunity for South Africans who are largely invested in South Africa or in developing markets, because it is a stable market that's accessible to us from not only from a language, from also a time zone point of view, and also our experiences. We can go and get involved in the market, and I think also being deemed to be more of a low risk market and also lower return market than something like Nigeria. However, in a portfolio I would expect that you'd have a part of your assets in a lower risk destination like the UK. And
what kind of returns can we expect going forward? I mean, if you had to buy into commercial property in the UK, I mean, what could you peg your returns to be over an annual basis?
I mean, that's always how long is a piece of string. But I think that if you look at your income return, your ungeared income return would usually be on prime property between 5 and 6.5%. Rental growth there will be, I think, over the long term, we've seen 3% or 2.5% or 3% rental growth. I would look for more rental growth than that in the office market currently. But if you were to say over the very long term, if you weren't going to try to pick cycles, you would look around 9 or 10% for your all-in growth.
Sounds like a fair deal.